Building credit may not be at the top of your priority list, but it should be. Lenders will do a credit check when you apply for a new financial instrument, such as a loan or a credit card. They may only accept applicants who meet specific credit standards, such as having a good or excellent credit score. If you don't have good credit, you may be unable to obtain a low-interest mortgage, personal loan, or credit card, and you may wind up paying more over the life of the loan. You will be able to save money on interest payments and invest it in your future if you have a good credit score. Credit has an impact on more than just your capacity to get new financial products. Before making a job offer, some companies will review your credit history for any red flags, such as delinquencies or accounts in collections. The outcome of their credit investigation may influence whether or not they hire you. As a result, it's critical to develop credit so you can portray your finances in the best light possible, whether to a lender or a prospective job. Good credit allows you to qualify for the greatest financial solutions that may help you save money and achieve your objectives. Credit is simply borrowed money that you can use to buy everything from groceries to a car to a new home with the promise of repaying the lender at a later date, usually with a fee. To make larger purchases in the future, you'll need to develop a credit history or a track record of borrowing and repaying credit. Building a credit history is essential since credit allows you to purchase things in life, whether you want to buy a car, rent an apartment, buy a house, or acquire that fancy rewards credit card. You'll need a credit history. Obtaining a secured card is an excellent method to begin creating a credit history. Also, it will assist you in learning how to manage your credit card usage. A secured card requires you to pay a set amount of money down as a deposit in exchange for a credit card with a low credit limit. The money you put down, normally in a savings account, is used to secure the card and cover the costs if you don't pay on time. You'll still be borrowing money from the bank and paying your monthly payments with money separate from the deposit, but the deposit acts as a sort of insurance policy for the bank. You will receive your deposit back if you have paid off the card in full when you close it or switch to an unsecured credit card with the same bank. Before opening a secured account, check with the bank or lender to confirm that secured accounts are reported to credit reporting agencies. Most major banks provide secured credit cards. However, before you apply, make sure you understand the required minimum deposit and any additional costs. If you maintain a low balance and make all of your payments on time, the lender may agree to convert the account to a standard, non-secured account after a certain length of time. A strong credit score is useful for a variety of financial and personal considerations. You are more likely to get accepted for credit products, such as a credit card or loan, if you have a high credit score. Lenders will see someone with a 760 credit score more favorably than someone with a 550 credit score. Having said that, several aspects, including your income and job status, are considered throughout the application process. The higher your credit score, the smaller your interest rate will be. Low interest rates on personal loans, mortgages, and credit card balances can save you hundreds or thousands of dollars. The most significant aspect of your credit score considers whether you can be relied on to repay cash that have been given to you. This component of your score takes into account if you have made all of your payments on time for each account shown on your credit report. Late payments have a negative impact on your credit score. If you paid late, how late did you pay? 30 days, 60 days, or 90 days or more? The later your payments, the lower your score. An account sent to collections is a warning sign to potential lenders that you may not repay them. Bankruptcies, foreclosures, litigation, wage garnishments, liens, or public judgments are all public record and, from the perspective of a lender, are the most damaging marks to have on your credit report. The length of time since the prior negative occurrence and the frequency of missed payments both have an impact on credit score lowering. Someone who missed several credit card payments 5 years ago, for example, will be considered a lower risk than someone who missed one significant payment this year. The FICO score considers your credit utilization ratio, which compares your total debt to your available credit limits. This second most important component takes into account how much of your overall credit limit have you used. Don't think you have to have a no balance on your accounts to get good grades here. Less is ideal, but owing a little amount is better than nothing at all, since lenders want to see that if you borrow money, you are responsible and financially stable enough to repay it. How much you owe on various accounts, such as a mortgage, vehicle loans, credit cards, and installment accounts is important. Credit scoring software prefers to see that you have a variety of credit kinds, and that you handle them all carefully. The overall amount you owe, as well as the amount you owe in respect to the original amount on installment accounts, have an influence. Someone who owes $80 on a $500 credit card will look more responsible than someone who owes $9,000 on a $10,000 credit card. Your credit score also takes into account how long you have utilized credit. How long did you have commitments? What is the average age of your accounts, and how old is your oldest account? A long credit history is advantageous, but a short record is okay as long as you have made on-time payments and do not owe excessive amounts. This is why personal financial gurus usually advise leaving credit card accounts open, even if you no longer use them. Your score will be boosted just by the account's age. If you close your oldest account, your total score may suffer. Your FICO score takes into consideration the number of new accounts you have. It considers how many new accounts you have lately applied for, and when the last time you established a new account was. Hard queries might result in a little and temporary drop in your credit score. The score suggests that if you've recently created multiple accounts, and the percentage of these accounts is large in comparison to the overall number, you may be a higher credit risk. Because people often do so when they are suffering cash flow issues or are about to incur a large amount of new debt. When you apply for a new line of credit, lenders frequently do a hard inquiry, which is the process of evaluating your credit information throughout the screening process. This is not the same as conducting a soft inquiry, such as gathering your own credit information. The FICO system also examines whether you have a mix of other sorts of credit, such as credit cards, retail accounts, installment loans, and mortgages, when calculating your credit score. It also considers the overall number of accounts you have. Because this is a minor component of your score, don't be concerned if you don't have accounts in all of these categories, and don't establish additional accounts solely to broaden your credit mix. Your credit score might be anything from 300 and 850. Credit scores ranging from 670 to 739 are considered good. And a credit score of 740 or above will almost certainly offer you the best interest rates. Keep in mind that improving your credit score may take some time. Apps such as Credit Karma and NerdWallet can help you track your credit building success. Some bank applications also provide credit monitoring. Having a good budget in place and keeping up with your credit payments will go a long way on your financial journey.